Global Finance, Topic 5, Exchange Rate Systems and the Effects of Revaluation. In this topic, we'll talk about the advantages and disadvantages of different exchange rate systems, the effects of appreciation and depreciation, how exchange rates are determined within fixed rate, floating, and managed rate systems, and the causes and effects of major currency crises. First of all, let's look at what happened to the dollar. If someone asks you, well, how has the dollar performed over the last 5 or 10 years? That's really a hard question to answer because do you quote it against the euro or the Canadian dollar or the peso or the Chinese yuan? So to solve that problem, there's an index, the DXY. It's called the dollar index. It's a trade-weighted index of how the dollar is performing against currencies. And initially it was set to a value of 100, but what we can look at the index now from 1998 to 2012, and what they've done is they've taken a weighted average value of currencies in which we trade, or trading partners. So you would think it would be primarily the euro and Canadian dollar and the Mexican peso and the Chinese yuan. So when you weight the exchange rate, the dollar's exchange rate against our trading partners, what you see is since early 2000, it's been a steady decline in the value of the dollar, and it's almost near all-time lows. However, if I were to extend this out to 2015, the value has come back to about 95. So it's come back up, and it's been in the 95 range. So what we can say is the dollar's is a historical weak period, but it's been strong over the last year or so. Likewise, if we just say, look at the dollar price of the euro, see how the euro's performed, you can see the euro was initially strong, almost the opposite of the dollars, and then it's been leveling off. And now it's right about, it's at a weak period, it's about 115 in mid-2015 or fall 2015. So the euro has been kind of a normal range where it is now, but it's been on the decline since about 2008. So we're going to talk about how are exchange rates determined, what causes them to go up or down. So the first thing I want to talk about is a currency crisis, because that's going to come up a lot. A currency crisis, we're going to say it calls a rapid and disruptive change in an exchange rate. It's usually associated with a geopolitical or economic shock, and it's often associated with the failure of a fixed rate system or government involvement. So the most recent currency crisis, say in 2015, would probably be the Russian ruble and the Brazilian real. The Russian ruble collapsed in the last year, mainly due to a reduction in oil and gas prices, which puts problems or pressures on their budget, and due to some geopolitical events and disruptive sanctions against Russia. And Brazil has had problems due to a weakening economy and a political scandal. So let's talk about a rapid devaluation of a currency. It's most often associated with an emerging or frontier market. So emerging markets might be your BRIC country, Brazil, Russia, India, China, and frontier markets might be smaller markets than that. So what's the effect of a rapid devaluation of a currency? In the short run, the first thing that everyone notices is a spike in the cost of imports. So if the Brazilian real is declining, Brazilians are going to pay more for imported oil, gas, medicine, technology, food. So immediately the thing you're going to see is imports get more expensive. You probably also would notice a rapid reduction in foreign investments as firms try to avoid the uncertainty and devalued currency environments. And to the extent that, say, frontier markets have currencies or borrowed money in currencies other than the home currency, you might have countries or corporations within those countries that have to pay off debts that are denominated in dollars or euros, and it costs them more. So related to these events and uncertainty and weak economies and so on, what you'll find is that governments are often having to deal with budget deficits and often associated with layoffs and other austerity policies. So in the short run, you might see these effects. Now we feel that in the long run, the main effect of a devalued currency is 1, inflation, And the easiest way to think about that is, say, as oil and gas and food prices import prices increase, they're going to work their way through the supply chain and lead to a general inflation in the economy. So that's a real negative. Although there is a positive silver lining to a decreased currency in the long run. That is, a decrease or devaluation of a currency will tend to make your exports cheaper to the rest of the world. And you could have an export sector revival of the economy as people are brought back to work to fulfill the increased demand of exports. So let's think about who are winners and losers of this most recent strong dollar environment. So we've had an appreciating dollar environment recently. So think about who's going to benefit mostly from that. First, we'll look at, well, what about American companies that export and sell to the rest of the world? Or American outsourcers to the rest of the world. So when I say American outsourcers to the rest of the world, these might be companies that produce goods in China or India or Mexico or Canada, and then sell them in the US and the rest of the world. And what you see is if the dollar is strong, that means foreign exchange is weak or cheap. So outsourcers are going to be the main beneficiaries of a strong dollar, because the cost to pay off their, say, peso paid labor is going to get cheaper as the peso gets cheaper. Now you might also say, if the dollar is strong and a foreign currency is weak, say the euro, who's better off, American tourists in Europe or foreign tourists in America? Well, if the euro, say, is cheap and the dollar is strong, it's going to take less dollars to buy my hotels in Paris, or my Wiener Schnitzel in Vienna, or my beer in Germany. So a winner of a strong dollar are American tourists in Europe. Let's talk about exchange rate systems. So exchange rate systems are the set of policies, institutions, practices, and so on that determine how exchange rates change. So we're going to discuss free float, managed float, fixed rate systems, and dollarization. A free float system, that's pretty easy to think about. It's simply no government involvement, and the currency simply behaves according to supply and demand. To the extent that governments supply currency through monetary policy, and to the extent that foreigners and even domestic population demand the currency. So we'll talk about what determines supply and demand later. As opposed to free float, you could have a system in which you are pegged to another currency, or a government agrees to fixed exchange rates among a group of members. Or an extreme system would be, say, the eurozone, which is a fixed rate system within a country and then goes to the ultimate stage of actually issuing a single currency. So that's another system which there's heavy government involvement. And governments do this by trying to make their economies look similar. So if there's similar demand for your currency, it won't tend to change. So how do you get similar demand for your currency? We have similar economic environments in each country. So you have to have convergence of interest rates, inflation, growth, and so on. And then once in a while, the governments have to step in to, say, buy or sell particular currencies to try to get them back to their required exchange rates. Now in the middle, we'll call it managed float. So some people say, well, this is the best of both worlds. Sometimes governments will allow free float, but then they'll just step in and try to affect the exchange rate, or change the exchange rate, because they believe there's maybe either excess volatility or it's just an undesirable level. So we have free float, where supply and demand determines it. You have fixed rate systems, where governments try to cooperate or manipulate currency supply or demand. And you have managed float. And then lastly, dollarization or eurozation. This is a country that completely adopts another country's currency. So let's talk about the advantages and disadvantages of both. The advantages of a free float system is one that requires no resources or effort. So there is no government agency that has to monitor exchange rate markets to try to change them. And also, there's more possibly economic stability with a free-floating exchange rate. If our country is failing, either economically or even politically, the exchange rate or the value of their currency will decline. As the currency declines, their goods exports will get cheaper and exports will rise, which would then allow the economy to recover. So we call this the self-correcting mechanism. Self-correcting mechanism of a free-floating exchange rate. And also, lastly, there possibly could be less crises if you allow currency to float, which sounds counterintuitive, but I want to come back to this point when we talk about a fixed rate system. Now, a disadvantage of a free float system, some people say there's excess volatility as the exchange rate is going up and down, and it gets harder for businesses and governments to plan. Also, if you're not changing the exchange rate or have the tools to change the exchange rate, maybe the central banker loses a policy tool to try to depreciate the currency to spur exports. So that's a free float system. So let's talk about the opposite of that, or on the other spectrum, is the fixed rate or target zone system. So this is a system where the exchange rate is either pegged to something like gold or the value of another currency, or you agree upon, and within a region, agree upon a fixed exchange rate among the region. Or again, the most extreme is actually the eurozone. So the advantage is while it's fixed, there is no volatility, which means there's no exchange rate while it maintains a fixed rate. And possibly if you're cooperating within a group to maintain an exchange rate, maybe you're trying to keep interest rates low and inflation low and growth high and budget deficits low. So these are possibly good reasons to have a fixed rate zone. But here's the risk. The risk is the exchange rate is held at a certain level, and that deviates from where the market would allow it to be, or the market would put it. So you have these potential that if a country is failing, but the government holds the exchange rate at a particular level, at some point the government finds it's impossible to maintain that level. We'll talk about how they change it and why you'd run out of resources to maintain it. So if the country's failing and the currency is pegged for 6 months or a year, it could suddenly drop and rapidly drop. So there's potential for more crises if the exchange rate is fixed, versus in a floating environment, it's changing every day. So as more and more bad news comes out about the country, the currency may drop. Also, in a fixed rate system, a lot of resources have to be dedicated to maintain the exchange rate, and those resources might be better allocated to, say, fight business cycles. Now, in between this free float system and the fixed rate system, you have managed float. Now, some people might say, well, this is the Goldilocks solution, right? Not too hot, not too cold, it's just right. So it has the advantages, all the advantages of the free float system, but every once in a while the government can step in and just take care of excess volatility or a bad level. So an example of this might be recently Japan generally allows its currency to float, but recently they found that they believe the yen is overvalued and it's hurting their exports, and therefore they stepped in to devalue it. Now the difficulty with this system is it's difficult to know when and how to step in. So what level is too expensive, overvalued, and what do I need to do to change it? And what if I overshoot it or don't do enough? So it's really difficult to do. And lastly, dollarization. So again, dollarization is the idea of a country, say Turks and Caicos Island in the Caribbean. They use U.S. dollars as their currency. They don't have a native currency. And the advantage of that is, one, it facilitates trades with Americans. Two, is they get the use of a very stable currency. Right? They have the U.S. central bankers keeping money supply growth at, say, 2 or 3%. So there's no tendency for the government central banker of this small island to change monetary policy and be less stable. Now, the main loss is those islands potentially have the ability to issue their own currency, meaning they print pieces of paper and put the faces of historical figures or presidents or kings on it, and then people will give you goods for it. So it's really a big loss to give up the ability to print money. Also, once you give up, you don't have your own currency, you can't use a monetary policy to try to smooth out your business cycles. So these are your main systems: free float, managed float, target rate, dollarization. This gives you an idea of the types of countries that are dollarized at this point in time. So countries like Ecuador, El Salvador, Turks and Caicos Islands, Panama. And these are countries that are euroized. So an easy one to think about is Vatican City, which kind of sits right inside Rome. So that makes sense for them to use the euro, and some others. And you have countries that use the New Zealand dollar, Aussie dollar, and others. Now, our current system, most of the major currencies are floating. All right, most of the major currencies are floating. The Chinese yuan, some people say it's pegged or managed float, so I'll put that as a managed float. And then recently the Japanese yen has probably moved down to this list. But they go back and forth, in my opinion, between floating and a managed float. You have your dollarized and euroized nations. You have target rate zones like the ECCU, the Eastern Caribbean Currency Union, and the franc zone. I believe that's an African-based zone. And then you have a common currency zone, the big one, the euro. Then you have fixed rate systems, or pegs. So, for example, the Danish kroner was pegged to the euro, and the Hong Kong dollar is pegged to the US dollar. So those countries manipulate or try to affect the exchange rate markets to try to maintain a particular exchange rate, so it facilitates trade and reduces uncertainty. So when we talk about the eurozone, since it's such an important currency union, let's first talk about the EU. When people talk about the EU, we have the EU members. Not all EU members, which is kind of a free trade zone, use the eurozone or in the eurozone and have not their own currency. So the eurozone includes these countries, the big ones being Germany and France. So all these countries no longer have their own currency. They use the euro. And then you have euro-pegged countries. So again, the Danish kroner is pegged. Bulgaria and Lithuania are pegged, anticipating moving into the eurozone. And then you have free floaters. So British pound, Swedish crown, Polish zloty, Romanian currency, Hungarian forint, Czech koruna are all free floating. You also had your euroized countries that are outside the EU. And then you have Norway, Iceland, Switzerland, and Liechtenstein, which have kind of a side agreement with the EU to facilitate free trade, but are not also in the eurozone. And if you want to look at a map of the eurozone, you got the dark blue. Those are the countries that use the euro. You got your floating currencies: Poland, Czech, Romania, Hungary, Croatia, British, Sweden. You got Switzerland in here, which was pegged to the euro, but they've recently revalued their currency. So it gives you an idea who's in and who's out of the currency union. So let's talk about what determines an exchange rate in a free market. So I said supply and demand determine price in free markets. So who provides supply of currency? We'll say the government, through printing of money and providing of credit, so paper money, provide the supply. So to the extent that governments print more money, it's going to devalue their currency. So let's say in the short run, governments aren't printing a lot of money. So we'll say in the short run, the supply is relatively fixed. So then most of it comes from the demand side. So what will cause demand for a currency? Well, the main thing to think about is that currencies provide no inherent utility. All right, or they don't provide any investment, really. Right? I can't eat a euro. I can't clothe myself with the euro. The euro is not a piece of art. The euro is not an investment, right? It doesn't provide interest. So it's really the only reason you would hold it and especially for an American, the only reason I would hold a euro is for what a euro can buy. So I would buy euros if I want to go out and travel to Europe and I need a hotel room in Paris. I need to buy euros to pay for my hotel room in Paris. Or if I want to buy a beer in Germany, I need to sell my dollars and buy euro. So to the extent that you want to buy German and EU goods and services, then you'd have a demand for their currency. Now also, you need euros if you want to buy financial assets. Say you want to buy a Spanish bond because you feel it provided a good interest rate for the risk. Well, I'd first have to sell dollars and buy my euros. So the demand for goods and services and demand for financial assets in the eurozone create demand for the euro, and it would tend to appreciate the currency. So let's talk more about this. So for the demand for goods and services, we're going to talk about a couple reasons that affect exchange rate, namely relative demand for goods and services and relative inflation. Then we'll talk about demand for financial assets. So investors are looking for high real interest rates and looking for growing economies to buy things like stocks. And we'll talk about how governments affect exchange rates. So the first thing we'll talk about, as the thing I alluded to a minute ago, is that if you want German goods or Paris hotels, I need to buy euros. So say there's a hot new BMW being sold in the U.S. market. All right. And the BMW is a German car. So now, if I want to buy that car, I'm going to create demand for euros. And that's going to tend to appreciate the euro. Now, as an American, you don't really see this, right? I don't go to a bank, and if I want to buy a $50,000 BMW car, I don't go to the bank and take my $50,000 and exchange it for euro and take the euro to the car dealer. But in effect, you are. It has the same effect. So I go to my dealer and I want to buy that $50,000 car. I'm going to write them a check and give them $50,000. And then that dealer is going to put that in the bank for BMW. And then eventually money needs to be wired to where the car was produced. We'll assume it was in Germany. So what are they going to do? They're in their bank. They're going to sell dollars, buy euros, and wire the euros to Germany. So it has the same effect as if you bought the euros yourself. So when you have demand for European goods, German cars, French wine, you're creating demand for the euro, and that's going to appreciate the euro, depreciate the dollars. So one thing we like to think about is countries that have high net exports. Exports are greater than imports will tend to be appreciating currencies. So if you think about the countries with the highest net exports, if I think about, say, Germany, within the EU, if I think about the Japanese yen and the Chinese yuan, these are countries that are known to have high exports. Now, the European Union is a little bit tougher, but before the European Union, the Deutschmark was a very strong currency because they're an exporting machine, and people wanted their goods. It means they had to buy their currency. So countries that have high positive net exports will tend to be appreciating strong currencies. Now, related to this is the idea of the Dutch disease. So the Dutch disease refers to a potentially devastating effect of a strong currency. So what happened in the Netherlands is the Dutch found natural gas in the 1960s. That industry thrived, so people from all over the world wanted to buy Dutch guilders, which was their legacy currency before the euro. And they bought the Dutch guilders and used the Dutch guilders to buy natural gas. This drove up the value of the Dutch currency, which then hurt the other industries. A couple decades later, natural gas is depleted. Other industries have moved on because they're not competitive anymore because it was hard to sell, say, T-shirts and food when their currency was so strong. So it caused some trouble. It caused a recession for a long period of time in Netherlands. So we talk about the Dutch disease as a potentially devastating or bad effect of a strong currency. Related to this idea is inflation. Right? A country that's having high inflation, that means their prices of their goods are increasing. Now, why would you have inflation in a country? Well, maybe it's just increased money supply, which is, well, I kind of consider that on the supply side. So you have increased money supply. So more money chasing the same amount of goods. You might have excess demand for goods. So say, Germany just couldn't produce enough cars that might bid up the price of cars. Or you might have some scarcity of a particular good that causes the price to go up. For whatever reason, if a country has high inflation, that means their good prices are going up. That means there'd be less quantity demanded of those goods, which means their exports would fall and the currency is less valuable. So for these reasons, inflation is bad for a currency. It's going to tend to devalue a currency. Now, one really bad example of hyperinflation is Zimbabwe. So at one point in 2008, Zimbabwe reached a 66,000% annualized inflation rate. If I divide that by 365, that's about 180% inflation per day. So prices are doubling almost every day. So in that type of environment, right, you want to get paid daily. You might even want to get paid hourly because the price of bread would double by the time you're at work. So you can see how disruptive inflation can be. And related to that, their currency was devalued from in 1 month from 2 million Zimbabwe dollars per US dollar to 7 million Zimbabwe dollars to buy $1 US. That's 28 million Zimbabwe dollars to, say, buy a latte. All right, so the first two reasons we talked about demand for goods and services. Net exports is a good thing for a currency, but inflation's bad. Now, on the investment side, when investors looking for bonds or savings accounts, we're looking for high real interest rates. So when they want to deposit their money in banks and countries that have high positive real interest rates. Or if you want to buy a bond from one of these countries, you want a high real interest rate. So if there's an increased demand for, say, Australian bonds by Americans because they provide a high level of interest, there'll be increased demand to buy the Australian dollar, to then use the Australian dollar to buy the bond. That will tend to appreciate the Australian dollar. In other words, the dollar price of an Aussie would go up, the Aussie price of a dollar would go down. Related to that is economic growth. If there's high economic growth in a country, that's going to tend to appreciate the currency. If a country is growing rapidly, you want to buy their stocks. You want to buy real estate there. You want to open up a business there. All those things require you to buy their currency first. Now, the downside of that is, what if that growth turned out to be a bubble, which happened in 1997 with the Asian tigers, Thailand, Philippines, Malaysia, Indonesia. These countries initially had high growth, attracted lots of investment, but it turned out later they were a bubble and it collapsed. And then we have government's effect on exchange rate. In fiscal policy, when governments spend more money and run deficits, that creates more risk that their bonds might default, and therefore the bond is less desirable, so the currency would devalue. Also, in monetary policy, what if a country raises interest rates? If they raise interest rates, say real interest rates, that's going to create more demand for a currency, and that currency will appreciate. However, if they manipulate money supply, they can indirectly affect interest rates and therefore the currency also. But in general, if countries tend to increase real interest rates, they will appreciate their currency. A couple more historical events in currencies. The 1998 Russian debt default and currency crisis was actually a little bit similar to 2015 Russia. Oil and gas prices collapse, which then hurts the budget deficits of the Russian government. They then, in fact, default on their bonds and currency collapses. Now, the side effect, one of the big bets of LTCM, long-term capital management, was that the Russians would not default on their bonds. That one of the causes that led to the failure of LTCM. Also, the Greek debt crisis of the last 5 to 7 years is a situation of the Greek government running massive deficits because of high spending in public sector and the inability to collect taxes. This is putting risk that they'll default again and again, and the risk of them leaving the eurozone. And there's a lot of uncertainty. Well, how would they exit the eurozone? Would that mean the eurozone will fall apart and the countries would revert back to their legacy currencies? So therefore, that's causing some risk to the eurozone, and the euro is weak recently. The last thing is direct currency intervention by governments, especially if a government in a pegged system or a country like Japan that wants to devalue their currency. What they'll do is they can directly buy or sell currencies. So if the Japanese wanted to devalue the yen against the dollar, they could print more yen, use it to buy US dollars, and hold the US dollars in reserve. That'll bid up the price of the dollar and devalue the yen. You could also restrict inward and outward foreign investment to reduce, say, demand for a particular currency. Or you can mandate an official exchange rate. So the government could set up, say, you can only exchange currencies using official mandated rates, and it'd be illegal to use markets outside of the official markets. Related to currencies, one historical event that people talk about is 1994 Mexico, and they call this the Peso Problem. And I'll put a subtitle on that: Beware of Calm Waters. So this is a country that was trying to maintain an exchange rate. They're worried about a rapid devaluation of the currency and a currency crisis, like I talked about at the beginning of this topic. So the government, in order to prop up their currency, what they needed to do is buy Mexican pesos using dollars they had in reserve. So if you want to prop up a currency, you try to buy it. So the Mexican government was using the US dollars they had in reserves and buy pesos. The problem is it's only good as long as you have dollars in reserves. At some point, people realized that it was unsustainable. The currency was going to drop, and the government was unable to prop it up, and then the currency fell dramatically and led to some pretty bad problems. Now, there is a distinction between, say, short-run and medium-run changes to the exchange rate. In the medium to long run, I believe that all the topics or factors I mentioned, inflation, trade, net exports, budget deficits, real interest rates, growth, competitiveness, for exports, those are the things that determine exchange rate. However, in the short run, it's a lot of times dominated by speculation, portfolio flows, and news. So, say a large hedge fund wants to dump their euros and move into yuan or another currency. That might have an effect on a daily basis. On a daily basis, news and speculation about interest rates or policy news. Right? If I've mentioned that, say, the Angela Merkel of Germany has said something positive about bailing out Greece, that might prop up the euro. So in the long run, we think these are the major factors. In the short run, it could be portfolio flows or speculation or policy news about these events or other events. So the last thing we'll do is talk about a little poll. So we'll say, if the government announces today that the US CPI, a measure of inflation, unexpectedly rose in August, the question is, what do you think would happen to the dollar that day? Well, since inflation is bad for a currency because it makes goods more expensive, I would expect that the dollar would depreciate. Secondly, what if you read in the news that Germany has reaffirmed its commitment to back the Italian and Greek government bonds? What would happen to the dollar? Well, since the euro and the dollar are major world currencies, and Germany's action to back Italian and Greek government bonds would provide more faith that the eurozone will fall together, I would think the euro would be stronger. And as investors move into the dollar and sell the dollar, I think the dollar would be weaker. So I think that also would be weak, lead to a dollar to depreciate. Third, what if the Fed announces they are raising Fed funds target by 50 basis points to maintain the current level of inflation? Well, what we think that means is real interest rates are going up in the U.S., and that would tend to appreciate the currency. Now, if no one believed that the Fed is doing this to maintain current level inflation, what the Fed's really means is they're really worried about inflation. It could be B. It could be a signal that inflation is going to be an issue. So in this topic, we talked about the advantages and disadvantages of the different FX systems, the effects of appreciation and depreciation,